Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Sumera Abdi. Good morning, Sumera. What a sharp reversal from early morning levels. The Nifty opened at levels of 17,100, as you can see on your screen. It went on to hit a level of 17,176. That was the intraday high on the Nifty, and from that level, we've seen a sharp 180-point fall on the Nifty from the day's high. Currently, as we speak, we're trading below the 17,000 mark and hovering precariously close to our 200-day moving average of 16,992. We're hovering around that level. Yesterday, the markets dipped below the 200-day moving average, found support, and managed to close above it. But let's see what we do today. Right now, what we have on our screen is that the early morning gains have fizzled out completely. The markets are flat and well off the early morning session highs. We're going to watch for what happens in the global markets because we had a big fall in the U.S. markets yet again yesterday. But right now, the Dow Futures is suggesting that it's going to be a positive start, and the Dow Futures is currently up close to about 180, 190 points. It's the FMCG stocks where you are seeing a little bit of a resilience. The Nifty FMCG index is now up close to about 0.6%, but year to date, the Nifty FMCG index is still up close to about 18%. And even today, despite that intraday correction that you can see, it's many of the FMCG stocks which are currently holding up in the green right now. Pull up the gainers list and you would see there is something like a Britannia there with a 1.5% up move, HUL, ITC, and these stocks are still about 1-2% away from their 52-week high levels. On the losing side, you can see weakness in Adani Ports. In fact, in the last two trading sessions, you've seen a fall of 8% for the likes of Tata Motors, Hindalco, Maruti. The two-day fall yesterday and today morning, we're looking at declines to the range of close to about 7%. The Nifty Auto Index, just as a composite of what's happening in the auto, space, had seen a phenomenal rally from June, but now you can see gains fizzling out there. So the Nifty Auto hit a 52-week high on 15th of September, and from that level, it's fallen close to about 7.5%. And as you can see in that, losers list, you've got a Hero MotoCorp, you've got a Maruti. So these stocks continue to remain under pressure. Hi, that's the market updated numbers.
Hi, Reema. Morning to you as well. So let's get started because a lot of you watching would want to know how things are going to shape up from here. So the market has given up morning gains, slipped to the day's low. Mid-caps are underperforming. We'll talk about the market and the outlook with Shyam Sundar Bhatt of Exide Life Insurance in a bit. In just a few minutes, we'll be joined by the management of Route Mobile to talk about their revenue outlook, the impact of the currency crisis and their margins and much more. Also, in terms of buzzers, we have Maruti, SBI Cards and GSPL. All are buzzing in trade on the back of news flow. Details on all of these as well are lined up in the show. And the rupee recovers after a three-day fall. Bond yields also slide. We'll get you views from Finance Ministry's top officials. Finance Minister Nirmala Sitharaman, Finance Secretary TV Somnathan, and DES Secretary Ajay Seth. All of this and much more lined up for you over the next 60 minutes.
But first up, let's begin the show by inviting our first corporate. We are joined by Gautam Badalia, the Chief Strategy Officer at Route Mobile, on the show now. Gautam, thank you very much for joining in. Wanted to understand what the UK exposure is. I was looking at your annual report, and in FY22, I believe Route Mobile got nearly £129 million of revenues last year from your UK subsidiary. That's a substantial amount. That's a big business for you, and we've seen what's happening in the currency and the slowdown there. So first, if you could quantify how much does UK contribute to your consolidated business and what the impact of the currency depreciation will be?
Sure. Thanks, Reema, for having me on the show. First of all, the UK, the GBP revenue that we kind of see in terms of reporting, that's only the reporting currency. Lion's share of the revenue comes in USD. All the large clients, be it the Googles, the Facebooks of the world, are billed in USD. So per se, there isn't any significant exposure from a GBP, pound standpoint. Nevertheless, at this point in time, from our balance sheet as well, we have significant amount of capital commitment, which are in euros, and the depreciation of euro actually will augur well for us. So these are some of this capital commitment pertains to the acquisitions and the deferred considerations that we have kind of agreed upon. So we would on the contrary stand to benefit almost 5-6%. Because of the currency depreciation. And at this point in time, we are looking at locking in the rates by hedging some of those capital commitments.
Okay. Just one follow-up question and trying to get numbers here. What percentage of your revenues comes from UK? And secondly, what percentage of it is going to be billed in the pound? Because as you said, even though you have a UK exposure, a lot of the revenues from your UK clients may be billed in dollars. So what percentage of your revenues gets billed in sterling or pound?
So the billing in sterling or pound is negligible. I mean, it doesn't even warrant quantification because that's hardly any revenue that gets billed in pound. Yeah.
No impact whatsoever on your P&L from the pound appreciation.
So essentially, it will largely be, I mean, the benefit would be, I mean, on the conversion or translation of the balance sheet items to the P&L. So yeah, so we'll tend to benefit out of it. But on the contrary, I mean, just to kind of give you a perspective, we are a truly global company having operations, I mean, right from LATAM to UK to Nigeria, Africa, and India, Middle East. So we work in various currencies, and most of these currencies, I mean, so in some form or the other, I mean, lion's share of our billing is in USD. So 70% out of the total currency billing, 70% of the billing is largely in USD and Euro, out of which USD happens to be, I mean, significantly a big chunk. So the currency depreciation per se, I mean, helps us, I mean, as a company globally.
Okay, understood. Hi, Gautam. Morning. Are there any of your geographies where you're seeing any bit of, demand slowdown, or where you're seeing any other signs?
So one thing that is actually, and I would definitely want to kind of highlight this, is the digitization of the Indian economy. I mean, has tremendously kind of given a booster to companies like ours. The transactions, while they've reduced in terms of their quantum, but I mean, in terms of micro transactions, the transaction sizes have increased. So the volume of transactions have increased multiple times because of the transactions becoming more and more micro. And as a CPaaS company, we have tremendously benefited out of it. There are some markets where the slowdown impact is there, but I mean, we are not a very developed market focused player. I mean, we are largely in the emerging markets, and in the emerging markets, I mean, we haven't seen too much of demand slowdown, so to say.
Okay, so no impact on demand and no early signs, at least, of a slowdown. Can you talk about competition? Because in the quarter gone by, one of your competitors said that a large telecom company took over one of their clients by offering a very low price. Can you talk about the competitive landscape and what the subsequent RFPs are looking like?
So in terms of the competitive landscape, I think that was pretty much a one-off. Subsequent RFPs have happened at much more rational sort of pricing. So per se, I mean, we don't see that kind of a predatory pricing being prevalent in the market as we speak right now. Most of the RFPs that are kind of happening at this are happening at reasonable and healthy margins from all CPaaS players' standpoint.
So pricing is similar to what it has been? It may not be predatory, but is it lower?
So I think we are able to kind of the margins that we are kind of clocking on a month-on-month or quarter-on-quarter basis. We have been able to maintain that kind of margins. There is some amount of competitive intensity that's there. I mean, from one large telco. But having said that, because of the global environment, because of a lot of our global competitors having leveraged balance sheet, I mean, we are tending to kind of eat into a lot of market share from competition. So just to kind of give you a perspective, while we have always been guiding about a 50% growth rate for this financial year, I think with some of the recent deal wins, I think we'll be inching or achieving it closer to 60% rather than 50%. So that is the kind of momentum that we are kind of garnering at this point in time.
Just to understand, FY23 revenue guidance stands revised to 60%? Versus 50% earlier?
Yeah, so we're reasonably confident of 50%, but I think with some of the recent deal wins, I think it will be closer to 60 than 50.
Okay, and margins will be maintained at current levels despite the increase in competitive intensity from one of the large telcos. Is that correct?
That's correct. So last quarter, despite, I mean, that particular contract that you're talking about, that had gone live, despite that, we were able to demonstrate significant increase in our gross margins. So we don't see any reason why, the margins should kind of significantly go southwards from there.
Okay. Does the festive season bode well for you? Because your business is predominantly SMS still. and you generally have so many transactions taking place in the festive season due to e-commerce purchases, etc., which should bode well for the SMS business. Can you talk about Q3 and Q4 and what we should expect in terms of volumes?
So historically, Q3 has been, they've been our best quarter, so to say. And in terms of the split of revenue, H1 versus H2 happens to be about 45-55. So, H2 will be significantly better. Having said that, Q2, the way the Q2 is kind of ramping up for us right now, again, I think we would be kind of clocking historical revenue. This would be the largest revenue clocked by us in any quarter. And it bodes well for Q3. So Q3, we'll see this kind of momentum. We're driving into it. And some of the markets like even some of the markets in LATAM, like Messivian, the company that we acquired, for them, that is Q4 calendar year, which happens to be their best quarter. So, we are very, very buoyant about the forthcoming, Q3 for FY23. And hopefully, we should be able to kind of inch closer to a 4-digit revenue.
Okay, so Q2 should see record revenues and Q3 should be better because historically that is the strongest quarter for you, not just in India, but even overseas with markets like LATAM, right?
That's correct.
Okay, is there any kind of volume guidance that you would like to share? I know in Q1 you did close to about 25 billion transactions. What about for the full year?
So last year, we did about 52 billion transactions. In Q1 itself, we have done 25 billion transactions. Yeah. So this year, I think we should definitely cross the century mark, in terms of the volume of transactions.
Got that. So more than 100 billion transactions for FY23. I also read that you're looking at acquisitions, 2 of them, which you're confident should close in FY23. Could you throw some light on it?
Yeah, so I think we've done a fair bit of acquisitions in terms of geographical expansion into LATAM, into Europe, and both of them are really doing well. At this point in time, we are looking at integrating the acquisitions that we've done. From a strategic standpoint, next 12 to 18 months, we're looking at kind of integrating some of these large acquisitions. Plus, we may look at looking at enhancing the product portfolio, so expanding the product line. So there may be a few tuck-in acquisitions that we're looking at, essentially to kind of have a full bouquet of CPaaS offering, or rather a comprehensive bouquet of CPaaS offering. So they will be tuck-in. It will not kind of be very significant in terms of either the deal value or the revenue contribution. But we believe that we are investing into some of these technologies which are very futuristic. And in future, I think we'll definitely reap benefits of some of these investments.
So only tuck-in acquisitions, not large by way of revenue presence. Gautam, thank you very much for joining in. This has been an enlightening conversation. That's Route Mobile for you. The worry in the street was that UK, the company has a significant exposure to UK. But as the management clarified, that the amount that gets billed in UK in pounds is actually very negligible. Negligible enough that they don't even think it's worth quantifying. Because although they may have revenues from UK clients, it's actually getting billed in dollars. And things are looking up for the company that they've revised their FY23 guidance higher. They're now seeing the possibility of a 60% revenue growth this year. They could inch towards that, but 50% revenue growth is definitely in the bag. 60% is also fairly, quite likely in terms of Route Mobile's revenue. So, confident, sounding management, and the statements are very optimistic. Get into a break. Up next, we'll discuss what's buzzing in commodities. Manisha Gupta joins us next.
Hi, welcome back. You're watching Trading Hour. The focus now shifts to the commodity space. Manisha joins in as always, and today the focus is on crude. Hi, Manisha. Morning.
Samara, thank you so much for that. Well, I'm looking at the crude oil prices, which have pardon me, seen some steady moves coming in after 3 days of decline. We've actually lost more than 8% in last 2 or 3 trading sessions. That is because of the hawkish statements coming in from the central banks, the kind of rate hikes that we've seen, and the strength in US dollar, and the fears that the demand could continue to decline, and we could be looking at a surplus in this quarter. All of that has weighed onto the markets. But the reason that you are looking at that bit of a green tick coming back in case of crude oil prices, that is because there is a meeting of OPEC and allies on 5th of October, and the markets anticipate way that this is a third time around that OPEC and allies could agree on cutting output instead of increasing, looking at the kind of demand destruction and the price decline that we have seen come in for the crude oil prices. When you look at the prices itself, well, we have seen a 19% of a decline for the month of September. The last 4 weeks consecutively, it has been a decline in case of crude prices. For the current quarter as well, it has been a 25% of a damage that the crude prices have seen on the weaker side. Another thing that seems to be supporting prices is the hurricane season that is upon us, and a category 2 hurricane, which is named as Ian, is expected to cross Gulf of Mexico by the end of this week before it makes a landfall in Florida. And ahead of that, there are reports on how BP, Chevron and various other oil companies who have plants there have cut capacity and called back their personnel. 15% of U.S. production in sense of capacity happens in Gulf of Mexico, and that really seems to be impacting the markets there. Apart from that, the street will also watch out for the U.S. Fed chair's statement by the end of this week on the direction going forward in sense of demand and rate hikes, etc. So that is something that would be on cues as well. And today you have the OPEC yearly report also coming in, which will tell you on what they are thinking about in sense of global yearly demand and supply numbers. So ahead of that, some buying is what we are seeing on the screen.
Manisha, thanks very much for that. Another quick break now. Up next, we'll talk about the market technicals. Joining in will be Mitesh Thakkar of earningwaves.com. Stay tuned.
Welcome back. Let's now shift the spotlight to the auto sector. Maruti Suzuki unveiled its mid-size SUV, the Grand Vitara, which is the brand's new flagship offering so far. 57,000 bookings have been made, and the company aims to deliver 5,000 vehicles by next month. We caught up with Shashank Srivastava, the executive director at Maruti Suzuki, and asked him how the Grand Vitara is poised to compete with rivals like Kia Seltos, Hyundai Creta, Volkswagen Tiguan, as well as Tata Harrier, amongst many others. Here's a slice of that conversation.
So it will appeal to a large number of customers, and that is the beauty of this segment. We hope to attract and take volumes from fresh customers, as also many of our competitors who are operating in this segment. We had crossed the 57,000 booking number. The production just started. And I would expect that during the next 1 month, probably we should be looking at around 5,000 or so deliveries. We are expecting the ramp up of production to happen subsequently. So obviously with 57,000 bookings, we are looking at much larger numbers when the production ramps up in the subsequent months.
And on the back of this new launch, what are brokerages talking about this stock? Sonia is here with the bull and bear scenario. Hi, Sonia.
Hi, thanks a lot for that. So definitely, there's a lot of buzz around this new launch, right? Launch at a price of 10.45 lakhs. The high-end variant is all the way up to 19.5 lakhs. Now, the bookings have been very strong at 57,000. But in terms of pricing, it's slightly higher, about 50,000 rupees more than the Toyota Hyryder. So a lot of brokerages believe that the pricing is not that attractive, and Maruti may find it a bit hard to penetrate this segment, which is highly competitive, the mid-size SUV segment. It already has well-established players like the Creta, and now with the Hyryder, the Kushaq, and several other players entering. It's going to be a bit tough for Maruti. So let's take a look at what brokerages are saying. Morgan Stanley has an overweight on the stock with a target price of 9,839. They say that market share gains are likely. The yen depreciation, though, can provide a margin cushion. So we're looking at first the bulls and then the bear case scenario. The market share gains are likely, Morgan Stanley says, because the order book is pretty strong, and Maruti is trying to plug a lot of their gaps in this sector. Nomura remains neutral. They have a target price of 8,970. They do say that they prefer M&M in this space because it's a highly competitive sector with the Creta, Seltos, Highrider, Aster and the Kushaq to compete with, although they are expecting a 25% volume growth for the company in FY23. And they also look at how the market share of the company could improve to 43 to 44% in FY23 itself. Now to the bear case scenario. These are brokerages which in any case have been a bit bearish on Maruti. Let's start first with CLSA, where they have been slightly cautious. They do say that this is a very hard space to penetrate, the mid-size SUV segment. They have a target price of 7,374 on the stock and they have a sell call over there. They say that, Maruti has been struggling with the SUV space, and since the pricing is not that great, the Grand Vitara pricing is slightly higher than the Toyota Hyryder, it may be tough for them to, move forth in this. So a bull and a bear case scenario coming through for Maruti. CLSA also says that they won't be able to gain significant market share in the SUV segment. Only time will tell how Maruti wades through this competitive segment. But for now, both bulls and bears present for the stock.
Sonia, thank you very much for that. Maruti is betting on this to grow its presence in the SUV space, something it's been lacking, versus its competitors. But let's talk about the market technicals because we've erased all our morning gains. The Nifty is now in the red, below 17,000, and we've also breached the 200-day moving average on the way down. Mitesh Thakkar of earningswave.com is joining in. Mitesh, what have you made of the morning so far, and does it open up more downside?
So, good morning, Reema. I think one important observation is that, we are, while trading right now below the 200-day average, I think we are in that zone of 200 average when the gap support at about 16,950 also comes in. So 16,950, 16,990, once we close below that, I think eventually we'll definitely go down. But if we start closing below that today, then I think an immediate test of 16,750 could happen. And possibly even on the worst case scenario, 16,500, 450 zone could be visible. So overall, structure is negative. What we have done is we have taken some profits on the short positions and trailed our stop losses very tight. And in case we get a bounce back, again around 17,200, 17,250, which is where the morning highs were, I think that's an area to again explore shorting because the daily chart has clearly become negative in the last few days of decline, and the indicators are also looking south. So trade with clearly short bias, but right now wait for 16,950 to be taken out on a closing basis if you want to add short right now. Otherwise, you'll get a bounce back, which will be a better entry point from the short-term perspective.
Hi, Mitesh. Morning. So, what are the stocks you're looking to trade today?
Good morning. So, Dalmia Bharat is something, which is clearly on the sell side. Cement stocks have seen some pressure and this one is breaking down afresh. So, keep a stop around 1550, look for targets of 1475. And Axis Bank is also something, which in the short term has negated the uptrend and could possibly decline about levels of 722, which is the 200 average. So, sell here with a stop at about 745.
Okay, thank you very much, Mitesh, for joining in. Need to slip into a very short break. Up next, we'll discuss market fundamentals. Shyam Sundar Bhatt of XI Life Insurance.
Hi, welcome back. You're with Trading Hour. Let us talk about some stocks which are buzzing in trade. Amongst them is SBI Cards. That's on our radar on the back of the company's performance in August. Abhishek has done the data crunching and he's here with all the details. Abhishek.
For the month of August, RBI's credit card data do suggest that SBI Cards performance is better than the industry average. So total cards have grown by 2% on a month-on-month basis, while, for the sector, we have seen a decline of 2.8% month-on-month. Total spends have increased by 1.24% month-on-month, while for the industry as a whole, it has declined by 3% month-on-month. However, average spends have declined by 0.8% month-on-month, which compares to a decline of close to 0.2% for the industry as a whole. So in terms of card issuance, they have gained market share for the first time in last 3 months. And in terms of, market share in spends, they have seen a first time market increase in last 5 months. In spends, their market share is now at 17.43%. This compared to 16.7% that they had in the previous month. So overall, a good data coming in for SBI Cards, and the festive season ahead is giving the stock, a cheer in trade today.
Thank you very much for that. Another important stock is GSPL. That's buzzing in trade. The management met ICICI Securities, and Sonal joins us with key takeaways. Sonal.
For that, well, GSPL said that the demand outlook in the near term is not so strong. However, in the longer term, the expansion plans and the tariff adjustments could mean that earnings remain stable for the company. They said that demand prospects are muted in Gujarat across all the sectors, which also includes the power and the city gas distribution space, from where the largest amount of volumes come in for the company as well. The contracted transmission flows have shrunk to less than 27 MMSCMD for the company in the second quarter, which is usually around 30 to 34 MMSCMD for the company, and they are unlikely to see much traction in the near term as well. However, on the flip side, use or pay charges and trading of cargoes at a price lower than the spot LNG prices at $30 per MMBTU. Remember, spot LNG prices in this environment are around $45 to $50 per MMBTU. So a lower purchase price could actually support earnings for the company. They have aggressive expansion plans and are looking at investing 2,000 crore rupees in various pipeline expansions. However, the tariff and expansion programs that I just spoke about is something that could provide fillip to earnings in coming years as well for the company. But on the back of near-term outlook being muted, ICICI Securities has cut their EPS estimates for FY23 and FY24 by 11% and 5%. They have a buy rating on the stock with a target price of 375 rupees per share.
All right, Sonal, thanks very much for that. Let's now talk about where the markets look to be headed and what should be your portfolio positioning. Shyam Sundar Bhatt, CIO at Exide Life Insurance, joins in now. Hi, Mr. Bhatt. Morning. Thanks very much for joining in. So in the near term, the outlook appears to be cautious for you and I guess for all market participants right now. But, you know, what should a person who has money to deploy now do? I mean, should they wait in cash or should they continue, staggering their investments? And therefore, which are the places to look for fresh investments now?
Thank you. Good morning to all. So the answer to your question would be that for someone who has money to deploy, a better strategy would be to deploy it over the next few months, because longer term outlook for Indian equities is definitely positive. The next 1 to 2 years, clearly, there is some amount of concern primarily on the valuation front, because while we may continue to do relatively better than global markets, directionally, the kind of environment we are in from the liquidity and global growth perspective may not really spell good news. But equities, as we all know, are one of the best yielding longer-term assets from a post-tax perspective. So this opportunity for investors over the next few months clearly appears to be, it definitely appears to be a good opportunity to stagger investments.
But what is it that you expect in the next few months? What do you mean by volatility? Should we expect significant downside or just some more time-wise correction? Because we haven't seen a big fall commensurate with what's happening globally.
True. So actually, we've seen, if we take the starting point as of October last year or so, since when the market started correcting, we've seen actually 3 or 4 moves of almost 10% in both directions, and on a net basis now we would be close to being flat, on a yearly basis. From a perspective of performance versus global markets, given the advantages that India has in terms of the political stability, the growth aspect, as well as relatively comfortable forex reserves, though of course we've seen $100 billion getting shaved off in the last year. All this will play a role in India being one of the favored markets. To your answer on in terms of volatility, so in both directions. So it's not that we may see a market which is continuously trended downwards. So we may actually be in for some more time correction, very similar to what we saw over the last year. Because if we consider that we are actually flat exactly at the same level as where we were last year, effectively we've had a time correction. But in the interim, of course, we've had big moves in both directions.
Okay. So, Mr. Bhatt, what are the sectors that one should be wary of at the moment? I mean, where do you not step at all?
So we do not really have any particular sector that we totally avoid. But yes, we do have an underweight position in most of the globally oriented sectors, primarily due to the uncertainty in terms of the growth aspect, as well as the pricing aspect in terms of global industries. So whether it's oil and gas, whether it is metals, two clear sectors which are where we are underweight. And we are also marginally underweight on the IT sector. Though, of course, given the kind of significant underperformance in that sector over the last few months, we may not see much downside in the IT sector from here. At the same time, while we are positive on the domestic economy, there are sectors on the domestic side also where we are underweight. Consumer goods, for example, which is favorably placed in terms of being able to withstand the current environment, but already baked into the valuations of many of the stocks. So we are underweight there. And the auto sector, which has actually done extremely well over the last few months, got the tailwind. We've got the tailwind for that sector in terms of a strong demand, as well as now cooling commodity prices. But again, the valuations appear to have factored in a lot of good news here. So we may look to add this sector only, at lower levels.
You must interact with a lot of foreign investors as well. We were hopeful that the FII's flow tide would have reversed after being, net sellers since October. We had started seeing early signs of FI inflows pick up, but once again, with the dollar strength, the rupee weakness, the FIs have started selling in the Indian markets, in the cash market, in equities. What is it that you expect and you're observing?
Right. So I'd like to answer it this way. The actions by the FIs can be typically because either it is a reflection of their view on a particular market, and second, it's a reflection of their underlying investors. So clearly, if you have underlying redemptions from the investors in these foreign funds, there would be a need to liquidate. And then, of course, the FIs will need to decide between the various markets that they are in as to where they would like to take money off the table. On this front, clearly, because India has done far better, not just in terms of the index, but also in terms of the currency. So while we've seen a sharp depreciation in the past few days, on a relative basis, our currency has still performed far better than most other currencies. So to that extent, from the FI portfolio perspective, the India portfolio would have done much better than most of the other markets, which possibly is one of the reasons for taking some money off the table. But at the same time, given that over the next 2 years, the competitive positioning of India is likely to improve considerably, in future allocations in the new calendar year, we may actually again see India being given a higher weightage than what we presently have. And hopefully by then, the time correction also would have enabled the markets to roll over to one more year forward. Because as of now, given that on a 2-year basis, we are at 18 times for a 12 to 13% earnings growth, there doesn't seem to be that much of upside in the index per se, while obviously individual stocks or sectors, we still see upsides.
Mr. Bhatt, thank you very much for your time today and for talking about the market outlook as you see it. A quick break. On the other side, we'll talk about the currency. The rupee has recovered after a 3-day fall. What's behind it and where?
Welcome back. Let's turn our attention to the macro picture. The rupee has recovered after a 3-day fall. Bond yields are slightly lower. Lata is here with the details. Lata.
Well, there clearly is some kind of an exhaustion or a peaking off of the dollar rally. It's, either flat or inches below its 114.5 that it had touched. It's like more closer to 14.05. This is also because a lot of central banks have intervened. First, the BOJ intervened, the PBOC has been intervening. So there is a sense of, enough, it has run enough, and there is a bit of a peaking off, maybe temporarily. So today we've seen many of the Asian currencies, or at least a handful of the Asian currencies recovering. The Indian rupee has recovered, so has the Thai baht, so has the Korean won. But we must be aware that there can still be a potential of reverses. The Chinese yuan has still been depreciating, and since we export a lot to that country and import even more from there, if the yuan depreciates, the deficit increases with China. So we have to keep an eye. The RBI may actually prefer a gentle depreciation like the yuan. But for the moment, the point is that Asian currencies or the world of currencies itself, currency markets, is catching its breath. And there have been no sharp moves after that over the weekend move in the pound. The bond markets as well in India are showing a decent recovery. Already yesterday we saw the 10-year spot yield recover a bit towards close because people had gone seriously short and they were covering shorts. Today we are seeing, you know, the OIS, the overnight index swap market, which is a very, very liquid market, which reflects the mood of the market. Also seeing yields either peaking off, staying flat like yesterday, or falling off. Now, why are they flat? Because already the 1 month OIS is factoring in a 50 basis hike by the Reserve Bank. Now, how much more is there for that yield to rise? Likewise, the 1 year OIS already yesterday was reflecting 6.9. I mean, that means the peak repo rate, the Reserve Bank should be raising it all the way to 6.75 or 7. That looks a little unlikely at this juncture. So there was a bit of an overshoot. And today we have seen all those yields also inching down by a couple of basis points. We will have to wait and see because the US yields are still in an upping mode. From 3.79, they moved to 3.82 overnight. So there is still an upward pressure. But at the moment, the Indian yields seem to think enough is enough.
All right, Lata, thanks very much for that. Also speaking exclusively at CNN News 18 Town Hall, Finance Minister Nirmala Sitharaman said the rupee is holding well against the dollar, adding that India is much better placed than many other countries whose currencies have plummeted against the US dollar.
How Indian rupee, because of the strength of our macroeconomic fundamentals, is holding out well, and the rate at which other currency vis-a-vis dollar has been, rate of fall of other currency vis-a-vis the dollar has been sharply much more than Indian rupee. So is that a consolation? Partly yes, because the strength of your economy speaks when you're talking about your exchange rate. And as a result, we are far better than many other countries whose currencies have fallen pathetically against the US dollar. Now, what is our strategy? The interventions, if at all, which RBI makes using the Indian Reserve, which I think nearly 75 billion has been used, essentially to stop the fluctuations, the severe volatilities. RBI is not aiming at fixing the rate, exchange rate. The government doesn't believe in it. Indian rupee and its exchange rates, the rate is also left to the markets to decide how it's going to float or get fixated at some level. So RBI's intervention is more to avoid the fluctuation. The US Fed's action has an impact on all currencies. So we'll have to only be sure that the fluctuation is not going to be severe. On the one hand, some people do also speak that, a falling rupee also helps. Some people speak, I want that to be clearly understood, that a falling rupee helps in exports. Whether it does or it doesn't, theoretically it may, but in today's condition with the recession outside and demands not really being as adequately as it should be, even a fall in the rupee may or may not help our exports. We are all conscious of these basic facts. We'll have to keep watching.
Watchful of what's happening on the global front. A fall in rupee may or may not help the Indian exports. We'll also get you some other important voices. Listen in to what the DEA Secretary Ajay Seth and Finance Secretary TV Somanathan had to say about the recent rupee depreciation and the impact on the economy.
It is not a concern, and is the view which you are expressing is overblown. Because if you recall that about 2 years back, when the reserves were of the same order, even then the discourse coming out in media, etc., and even by even other informed persons was that we have adequate reserves when they were 2 years back. Now, yes, there has been a depletion because of the inflows have come down, and at the same time the trade deficit at a higher level. But I don't see as a concern. India has a fairly large reserves.
It's an international phenomenon, nothing peculiar to the rupee. It's dollar rise, not rupee fall.
So, but is that a worry for you?
No.
Hi, welcome back. You're watching Trading Hour. Here's some market opinion. Earlier today, We caught up with Nilesh Shah, MD and CEO at Envision Capital, who says that it's a good time to start accumulating IT stocks and has also spoken about his market outlook. Hear him out.
The valuations, the P multiples have become a lot more reasonable. And our view is essentially that don't expect the margins to further deteriorate from the current levels. The demand environment still is pretty much intact. We've not heard of any IT companies talking of any slowdown in terms of demand, even if we reflect back to the past crises which markets like the United States or Europe faced. Even in that kind of an environment, the demand for Indian IT services companies was pretty much non-discretionary. So to that extent, we now see an environment where the demand is intact. The margins perhaps have moderated or have bottomed out, I'd say, and valuations have become a lot more reasonable. So from here onwards, we don't expect the IT sector to be an underperformer. I think it's a good time to start accumulating a lot of high-quality, growth-oriented IT stocks. I still expect India to be an outperformer in context of what's happening globally. Just look at some of the growth estimates. The fact that GDP growth is still expected to be 6 to 7%. Inflation is going to be still subpar what we are seeing in developed markets, and at about 6 to 7%. We're still talking of nominal GDP growth of about 12 to 13%. And with margins now expected to improve because of the way commodity prices have fallen or the raw material and input prices have fallen, expect margins to probably kind of hold up or even get better over the next 2 to 3 quarters. So overall, the way we look at India is that we see a nominal GDP growth of about 12 to 13% and maybe an earnings growth which is in probably the high teens. Autos continues to be one of those opportunities of growth from an India context. I think combined basis autos and auto components is a space we've been pretty optimistic about. We've been owning it in our portfolios and continue to like this space. Of course, some of them have, of course, run up quite a bit, especially in the auto hang space. So, of course, you could probably, take some profits off the table. But otherwise, it looks that for the next 2 to 3 years, Indian autos and auto components put together are kind of going to be on a comeback trail. Some of it is priced in. We're getting into an environment where we could probably see a double-digit growth in demand, backed by margin expansion, which I think is pretty good in terms of earnings growth from a 2 to 3 year perspective.
Okay, that's the view coming in from Nilesh Shah. He's saying that IT perhaps may not fall so much from here. By the way, the markets have recovered. So from the day's low, we've managed to climb back above that 17,050 mark. It's a gain of close to about 0.25% on the benchmark indices and individual names. Keep an eye on HCC. It's a small company in terms of a price. Now the stock price is just 14 rupees, but it's rallied about 18%. This is after their debt resolution plan was approved. Now the debt on the company's books will come down to 3,575 crore, which will help the company save 400 crores in annual interest payments. Big mover there. Wrap up on Trading Hour from the entire team. Thank you for watching. Stay tuned. Halftime report is up next.